Let me ask you something. Think about the last time you felt genuinely uncertain about money. Maybe it was when inflation hit and your grocery bill jumped $200 a month without you changing anything you buy. Maybe it was when interest rates spiked and suddenly your mortgage payment looked completely different. Or maybe it was just that quiet, creeping feeling, scrolling through the news, watching things feel unstable, and thinking, is my money actually safe? If you felt that, you're not alone. And more importantly, you're not wrong to feel it. Because here's what most people don't know. The feeling of financial uncertainty you're experiencing right now, people have felt this exact same thing at dozens of pivotal moments throughout history. And every single time, there were people who came out ahead and people who didn't. The difference wasn't luck. It was a handful of very specific decisions. Let's talk about what those decisions were. Look, when most people hear protecting wealth during uncertain times, they immediately think one of two things. Either they think, I need to sell everything and hide in cash, or they think, this is just fear-mongering, I'll just write it out. Both of those instincts, historically, have been wrong. The people who sold everything in March 2020 when COVID crashed the market missed one of the fastest recoveries in stock market history, a 100% rebound in just 12 months. But the people who did nothing during the 2008 financial crisis and held concentrated positions in financial stocks, some of them lost 70, 80, even 90% of their portfolio value, and many of them never fully recovered. So the answer isn't panic, and it isn't paralysis. It's something in between, and history gives us a remarkably consistent roadmap for what that looks like. Here's a stat that genuinely surprised me when I first encountered it. According to research from Hartford Funds analyzing data going back to 1928, the S&P 500 has experienced a 20% or greater decline, what we call a bear market, roughly every 3.6 years on average. Every 3.6 years. That means if you're investing for 30 years, you should statistically expect somewhere between 8 and 10 serious market downturns during your investing lifetime. Not 1 or 2, 8 to 10. And here's what's even more striking. The average bear market lasts about 9.6 months, but the average bull market, the recovery and growth period after, lasts about 2.7 years. So the math is actually on your side. If you stay invested, the good times are roughly 3 times longer than the bad times. But, and this is the critical part, only if you protect yourself well enough to survive the bad times with your capital intact. That's what history's wealthy survivors understood, that most people don't. Let me take you back to 1929. Most people know the Great Depression wiped out fortunes, but what most people don't know is that it also created some of the greatest generational wealth in American history for the people who were positioned correctly. Here's what they did. Before the crash, the families who preserved wealth had reduced their exposure to highly speculative assets, the roaring 1920s equivalent of meme stocks. They held productive assets, farmland, real estate, businesses that produced essential goods, and cash. When the crash came, they didn't panic sell, and crucially, because they had liquidity, they could buy when everyone else was selling. A study from the National Bureau of Economic Research found that between 1929 and 1933, the wealthiest 1% of Americans actually increased their share of total national wealth during the Depression, not because they were heartless, but because they had prepared. Think about what that means. The same economic catastrophe that wiped out millions of people's savings simultaneously transferred wealth to those who were positioned for it. That transfer didn't happen by accident. Now, here's what's fascinating. When you look across multiple periods of economic uncertainty, the Great Depression, the 1970s stagflation, the dot-com crash, 2008, COVID, the wealth preservation strategies that worked share 3 consistent principles. Principle 1, real assets over paper promises. During the 1970s, when inflation hit 14.5% in the United States, people holding cash in savings accounts were losing purchasing power every single month. But people who held real estate and commodities saw their wealth hold, and in many cases, grow. A house purchased for $50,000 in 1970 was worth over $200,000 by 1980. That's a 4x return during one of the most economically turbulent decades in American history. Not because real estate is magic, but because real assets tend to hold their value against inflation in ways that paper assets don't. Principle 2. Income over growth during uncertainty. When markets are volatile, the investors who sleep at night are the ones getting paid regardless of what the market does. Dividend-paying stocks, rental income, bonds with fixed coupons. These create what financial historians call income certainty in a world of capital uncertainty. During the 2008 financial crisis, the dividend yield on the S&P 500 briefly exceeded the yield on 10-year Treasury bonds for the first time in over 50 years. The investors who recognized that signal and bought dividend-paying stocks during the chaos, when prices were low and yields were high, earned extraordinary returns over the following decade. Principle 3. Geographic and currency diversification. This one surprises most people. When the Argentine peso collapsed in 2001, wiping out middle-class savings overnight, Argentinians who held a portion of their wealth in US dollars or foreign assets were largely insulated. The same pattern repeated in Venezuela, Zimbabwe, and Turkey. You might be thinking, but I live in America, that can't happen to me. And maybe you're right, but the principle of not having all your wealth denominated in a single currency, in a single country, in a single asset class, that principle has protected wealth across every continent and every era of history. Here's the part that most financial content skips over, and I think it's actually the most important part. Knowing what to do and actually doing it are two completely different things. There's a reason most people don't implement these strategies even when they intellectually understand them. It's because of something behavioral economists call present bias, our brain's tendency to value what's happening right now infinitely more than what's coming in the future. When things feel stable, protecting your wealth feels unnecessary, almost paranoid. When things feel unstable, protecting your wealth feels too late, futile. The window where it feels exactly right to act, that window is almost always closed, because by the time the media is talking about protecting wealth, the protection opportunities have already been priced in. Think about buying insurance. You don't buy car insurance after the accident, you buy it before, when you don't think you need it. Wealth protection works exactly the same way. The investors who came out of every major historical downturn in the strongest position weren't the ones who reacted, they were the ones who had already prepared during the calm. So here's your historical playbook: 4 moves that have proven themselves across a century of economic uncertainty. Move 1. Audit your real asset exposure. What percentage of your net worth is in real estate, commodities, or inflation-protected securities like TIPS? If the answer is close to 0, history suggests you're overexposed to paper risk. Move 2. Build your income floor. Identify what portion of your monthly expenses could be covered by income-generating assets, a loan, dividends, rental income, bonds with fixed coupons. These create what financial historians call income certainty in a world of capital uncertainty. Move 3. Stress test your portfolio. Ask yourself, if the market dropped 40% tomorrow and stayed there for 2 years, what would you actually do? Would you have enough liquidity to hold on or even buy more? If the honest answer is no, that's your signal to adjust now. Move 4. Add 1 layer of international exposure. This doesn't mean converting your life savings to foreign currency. It means that putting even 10 to 15% of your portfolio in international assets, global index funds, foreign real estate investment trusts, or multi-currency holdings gives you a buffer that pure domestic investors don't have. History doesn't repeat, but it rhymes with remarkable consistency. The people who understood that uncertainty is not the exception, it's the recurring condition of every era, those are the people who protected their wealth, grew it through the chaos, and passed it on. That knowledge is available to you right now. The only question is whether you act on it before the next chapter of history begins, or after. If this reframed how you think about uncertainty, share it with someone who needs to hear it. And next week, we're going deep on exactly which assets have outperformed in the last 5 major downturns with the specific numbers.